is because of a situation like a divorce or a hardship of some sort, right?
Hmm.
Get themselves in just a little bit of credit trouble, and they'll say, "Oh, nothing too bad. It's just a couple of lates and whatever." And my credit score used to be in the sevens, and now it's in the low sixes. But I
Hmm.
want to get it back up, so I'm getting a lot of that. It's not destroyed in the low fives.
Got it. Got it. So in the
Hello.
600 range. Oh, you're on
Yeah.
mute.
Hi guys,
Hey,
Hi, Jessica.
how are you, Brian?
So that's
Haven't really
that's
been
what
about
I'm
you.
running into a little bit of.
what are you seeing right now, Jessica, as far as credit for your clients?
We haven't seen anything that bad lately. And by bad, I don't mean we can't work with it, but yeah, I haven't run, I'm trying to think. Yeah, I haven't run into anything.
Ryan's seeing like that 600 range, so not the 4 to 5s, but having like a little bit of blemishes. Are you seeing higher credit card utilization too with those types of clients, Brian?
Yes.
Okay. Yeah, so
Is
it's
that
that
Yes, yes, and yes.
combination.
consumer? Is that more on consumer credit cards?
Yes.
Yeah.
So,
That,
one of the things you say is, hey, if there's some cash laying around, not to cut into too much cash that we might need for down payment and
mhm.
closing costs and all that good stuff. But here, I want to get better at knowing, okay, which card, which payment, when to make it, like to dive a little bit deeper into helping them understand what would be a good thing
Okay.
to pay down a little bit and that kind of thing. I'm still not really clear on that.
Okay, I'm writing that down because I'll make sure we focus on that today.
Nor
So
maybe that shouldn't be my job, Ivory. Maybe it's directing them to you folks and letting you work your magic.
yeah, sometimes, it depends. Great answer, right? It depends. But there's definitely a lot of scenarios where it gets murky really quick, and then it's just better to hand it off if it's very, very much a lack of clarity. Um,
Yep.
but there's some hard and fast rules that I'll discuss today with what we have put together, and that'll
Brian,
help.
are you a mortgage lender? Is that what I'm gathering?
I I am. I work with Homeside Financial, which is
Oh,
owned by Lower. Yep.
okay.
I've only been in the business for about 3 years now, but I've been in the financial industry for many, many years, always in a different facet of finance, but got into mortgage about 3 years ago, right at the tail end of COVID. I kind of missed the boom. I started a credit union. I was there for 2 years, and then the credit union let everybody go about 8 months ago. And so I jumped on board with a buddy of mine at Homeside Financial. So a
Oh.
mortgage lender.
Yeah.
Long answer to your question. Sorry.
No, that's great. I do
Who are
business.
you with?
I'm with First Citizens and we do only business banking. We can do consumer, but my team is not consumer. So
So if
when
I understand what
Ivory's
you say,
asking me
you're
business lending.
commercial lending, business lending, commercial lend, like commercial real estate, or business as in business owners need a
Um,
loan.
yeah, so we can do business credit card all the way up to commercial purchases. So
Gotcha.
land,
Cool.
building. Mhm.
Cool.
Yeah.
Okay, well, we'll jump into it. Um, it's just the three of us for now, so I would say let's make this work for you and what you want to know. I'll go through what I have as far as I'm looking at my other computer. I'll go through what I have here as far as the prepared items, but let's just make sure we're covering topics you care about as far as for the most part. I'm going to start sharing my screen. Maybe. I always seem to struggle with this part. Yeah, screen two. And then
And then Ivory, please share with us, as AI gets utilized more and more into everybody's business, how it's helping you help us,
oh, absolutely. Okay. I'll write that down too.
right? Makes sense?
Absolutely. That's part of the point of today, helping us help you. Okay. So purpose of today is navigating credit myths. A lot of these myths sound like common sense when they aren't. So unfortunately, credit isn't always intuitive. So the point of today is to be able to dispel some of these myths. Clients and you, if you're on social media, are seeing a lot of this misinformation being spread. And then of course, at the end, we're going to have open Q&A. But again, throughout today, please just let's make it a conversation. That's really the whole point. So obviously, this all matters. We want to be giving the right information to clients. We want to be advising them the right way. We don't want to misadvise and have scores go down instead of up. And then, of course, you want to be knowledgeable. You want clients to see you as not just someone who's doing a transaction, but as an advisor, someone they can count on, someone they can refer their friends and family to. And I'm going to introduce myself. You both know me. So my name's Ivory. I own Insight Strategies, but also am co-founder of Credit Score Pro AI with Allie, who you see on the screen here. Allie's stuck on a call. She'll be joining us at some point in time. And then I'll let her introduce herself a bit more. But she has been in the industry for 20 plus years. I've been in the industry about 15 years at this point, both in different areas. So we're really able to take our separate knowledge bases and put it together and make a super cool AI product. And we'll look at that a little bit more later. Oh, I zoomed in. I didn't even know you could do that. And we'll look at that a bit more later. So I wanted to take a look at the market 2020 through 2022, and then what we're seeing 2023, 2024, and how the consumer looks different. Because this is going to matter for every single one of us. Not just in the here and now, but over the next couple of years. So specifically with mortgage lending, we know about 3 in 10 people who inquire close on the mortgage, right? So not a lot of people who are interested in getting a mortgage actually finish that process. Biggest issue is credit and debt to income. And this is in the standard market from 2020 to 2022 timeframe. So as far as what stops someone, it's about 53% credit history issues and debt to income issues. We're seeing that increase in general. Everything is tightening as far as those lending requirements when we look across the financial services industry overall. And part of why things are also tightening is because we're starting to see increases in default. We're starting to see changes in consumer behavior. So in summary, before I get into the details here, younger borrowers are looking very different. We've got lingering debt and credit issues from COVID. These issues are affecting credit now, and a lot of the assistance options people had allowed them to prolong the, how do I want to put it? Prolong the negative effect to their personal balance sheets, to their credit reports. And now we're starting to see trickling of some of these effects, or this dominoes starting to flip over. As you know, you live in the United States just as I do. Everything's more expensive. We're seeing increased debt to income ratios. And if we look at a consumer who went to get a mortgage in 2020 versus 2024, the average mortgage payment for that new consumer is 78% higher. That's crazy.
That seems like a pretty big number.
Right? Right. And we wonder why it's so hard right
78%
now.
higher?
Mm-hmm.
Wow, that's huge.
Mm-hmm. Yeah, it is. And it's not just because of interest rates, right? It's house prices as well.
Oh, of course, yeah.
Okay, so what's happening with consumer debt? To summarize this slide, basically people have higher credit card debt, they're not paying it off, and the balances over time are increasing. So opening more cards, carrying the balances, maxing those cards out, and then not paying them off. We're also starting to see a bit more in delinquencies. So the important thing to know about delinquencies is when we look at these different categories of credit scores, we break them down into subprime, near prime, prime, and super prime. So the subprime is that below 600 range, near prime is that 601 to 660, prime 661, 780, and then 781 plus is super prime. The individuals that are in that prime category of the 661 to 780, we're starting to see a shift higher and lower. So more people in that prime category are dropping down to near prime, and then the others are going up to super prime. So we're seeing just this departure from that category. And those in near prime are dropping down to subprime, and subprime staying put. So it's not necessarily all bad. It's not that everyone's credit score is dropping, but a large portion of the public is seeing a lowering of the credit scores down a category or down a bucket. So that divergence is something to pay attention to if we are looking at originating in the future. And then how do we handle those types of clients? How do we handle those credit situations that aren't super shiny like the prime and the super prime that we were seeing in the past? And then on top of that,
Question, Ivory.
yeah.
I'm sorry. I'm gonna
Please.
just touching on the point you just made.
Mhm.
When you see these changes and the near prime bumping down to subprime, and then you want to help these folks because we are originating, are you finding that these days at this point in time, does it take longer, just as much time, or shorter to make changes in their scores? Is it harder or easier, or just as hard as it was, a year or two ago to make changes?
I would say if the main driver for score decreasing is the credit card usage, it can take longer because they don't have the funds available. The caveat to that is it really kind of depends on that structure of the credit report, because if there's a lot of other opportunity, we still may be able to see enough of an improvement from other means, but it has to be just like that perfect setup for it to be that case. Because at a certain point, you kind of hit a cap. If your credit card utilization is so high, you can remove everything negative off your credit report, have everything else look great, but you hit a headwind, right? It's kind of a blockage that's stopping you. But part of what we'll talk about, because I know it's one of your questions, is, well, how do we tackle those credit cards? How do we go about it in the most effective and efficient way with the credit scores in mind? So my answer is kind of yes and no. So
all good.
It definitely does depend. And it's also interesting too, in general, we're seeing a decrease in originations across the board, with the exception of auto loans. The auto loans one I find interesting because the interest rate on auto loans are really high right now too. And then if we look at delinquencies and we break out delinquencies specifically, looking at in this first section, it's the subprime. So about 21% of those in that subprime tier, which is that 600 credit score or under, are reporting a 30-day delinquency. About 30% of mortgages are reporting a 30-day delinquency in subprime. Almost 16% of personal loans, and then about 18% of credit cards. And if we break that out by generation, what we're seeing more of is that the younger the generation, the higher the likelihood they have delinquency. And I'm going to pause here. Allie's just joined us, so I'm going to go ahead and pause. And Allie, why don't you introduce yourself?
Okay, so my name is Alicia Alt, also known as Allie. I am a credit expert. I am one of the co-founders of Credit Score Pro. What else do you want to know about me? I have 21 years now of experience in the lending and credit industry, including real estate.
Perfect. And other than that, Allie, we were just starting to dive into what's going on in the industry right now, where we're at with delinquencies and credit card usage. And today, I know we want to place a focus also on credit cards in general. How do we properly advise our clients in paying those down with credit scores in mind, especially when there's limited funds? We need funds for closing, right? And then also how AI is helping, how we are helping people with AI, how AI is helping us help you. But you said it wrong. I'm trying to repeat Brian. Yeah.
Is that
So
something you wanted me to?
I guess my question when I said that to you, Ivory, was what are you finding in your industry as it relates to AI, of course, that is new and improved or groundbreaking that's able to help us. So
yeah,
that's just looking to see what's new and happening on the credit side, on your side, credit repair side.
yeah, yeah. That's what I was trying to repeat back. It's just, I jumbled it up.
All good.
So, I mean, really, what some of this is showing on the delinquency side is, I think I'm drawing an inference, more of a financial literacy crisis. Uh, those in the younger generations, they don't necessarily have that financial education. It's not being taught in school. And unfortunately, we're starting to see those younger generations learning the hard way. So that's one of the inferences I draw. I don't know, Allie, if there's anything you want to add on the delinquencies that we're seeing right now or the general economy.
No, I do think it's a financial literacy crisis for sure. I think my passion around that. I also think that we're living in a different age of how we consume goods. We're a disposable economy opposed to in the past where, we try to save money. We wanted to, we kept things for as long as we could. We weren't throwing away and getting the next best version. We're not that way anymore. We want the next big version, and those seem to come yearly now, right? So we're having, and these younger generation, they're really caught up in that, and they think that they have to have the next iPhone sitting on their hip, and everyone's got to see that or whatever that might be. So I think that's part of the issue. So we're accumulating more debt because of that, right? And then if we're accumulating more debt, but then in our economy, we're not making more money, right? We're hurting here. Then what's the obvious thing that's going to happen, right? We're going to have default rates increase. That's my take on it. So we need to become a more resourceful economy is what we need to do, and not a disposable one.
Yeah.
That's a whole different other subject though, right?
I don't know. I found that super interesting. I think it's great.
Okay.
I think one thing every client likes to talk about is inquiries. So I thought that'd be a great place to start with some of the myths. So soft inquiry, you're going to see those on your credit report. If you have clients that are using like Credit Karma, some of the credit monitoring, they're not differentiating for your client the soft inquiries versus the hard inquiries. I think that's important to know. They're seeing every single inquiry and thinking they're getting a credit hit every time they see that inquiry on their credit report. So when it comes to inquiries, you're going to see them on the credit report for 2 years. They're only affecting the score for 1 year. And I think that surprises most people. There is also anything you want to add here before I go into the dedupe and all of that, Allie?
Well, no, I like what you were saying about how when a consumer's looking at their credit report, and even lenders, I hear it from lenders too, we see the soft pulls, we see the hard inquiries. We also see the credit checks which are not really considered soft pulls even, from, if I have a Chase credit card, they're going to constantly be checking over my credit as well. Those are going to be on there. And they're coded a certain way, but a lot of people don't understand what those codes mean. So then they think that they look at these inquiries like, holy cow, there's like a million inquiries, but maybe most of them were no effect to the credit score whatsoever, or have any cadence in whether or not they would get approved for a loan because of the credit pulls, right? Hard inquiries obviously being the exception. But like what Ivory said, a lot of people think, oh, these are on my credit report for 2 years. They're hurting my credit for 2 years. They're not. They're hurting your credit for 1 year. Unless you're looking at business credit, that's a whole new avenue. They're not affecting the score, but they are affecting the fundability portion of it.
Yeah, and I think the other thing I like to look at an inquiry as just like a red flag. It's something that says I'm applying for debt. It's really just a signal that Someone's looking for debt, so either they're potentially having monetary issues or they've opened an account. So be aware, if you're going to lend to that consumer, they may have a new opened account. It's just meant to be a signal. It's not meant to be something that destroys credit, right? And there's this long-standing argument around how inquiries are looked at in mortgage lending, how inquiries are looked at in auto lending. So I thought it would be good we break that down. So we're going to look at what is the dedupe period when it comes to credit inquiries. So the dedupe period is looking at, I'm gonna use mortgage lending for this example. So specifically, you have protections with inquiries in these areas: mortgages, auto loans, and student loan inquiries. Okay. So for my example, I'm going to use a mortgage. If you have a client who's applied for a mortgage and they had 5 inquiries within a set time frame, that inquiry impacts the credit just once. Now, within 30 days of that initial credit pull, it does not affect the score. After that 30-day time frame, all inquiries for that mortgage within 45 days only count as 1 inquiry. Now, that's true for the newer versions of the credits of the FICO credit score algorithm. With the older versions, it's anything within a 14-day time frame. So a lot of times you see this arguing back and forth because people are correct. It just depends on the type of credit score that's being looked at. Does that make sense?
So if I understood what you said, it used to be 14 days and now it's more like 60 when you have a mortgage company that has the soft pull, maybe a hard pull up front, and then has to do another pull week of closing. So they have more than 1 inquiry over a period of time, but it's usually within 60 days. So it's longer now than it used to be. Is that what I understood you say?
So within anything within 45 days only counts as 1 inquiry. It just doesn't start affecting the credit till after 30 days. Does that make sense? After 30 days.
Made sense until that last thing you said. So 30 days, it's all 45 days, it's all 1 inquiry. But if they have another inquiry 31 days after the first, that is another hit to the credit, or is it 45 days total window, 45 days?
Allie, can you try to clarify for me?
So if I had my credit score pulled for a mortgage today and then 30 days later I got it pulled again, that's going to be considered 1 pull.
Right.
Okay.
What if it's pulled 40 days later?
Same thing. We
Okay,
have,
so it is a 45-day window.
yeah, we have that 45-day window.
Okay.
Correct. Yeah.
Thank
I think what Ivory's trying to say is when I pull it today, is it going to affect my score today? No. It's not going to,
Yeah.
it's not going to
That's
affect.
correct. That's what I was trying to say.
Yeah.
Okay, it doesn't affect it until 30 days later. Is that what you said?
Mm-hmm. Yep.
Okay. Thank you for clarifying that, Allie. Come on, Ivory.
I'm
So
trying.
then, so question, Ivory. So then if somebody pulls the score 40 days later, they will see a score, they will see a lower score, but it still only counts as 1 pull.
Mhm.
Correct.
That would
Okay,
be correct.
crystal clear. Thank you very
Yes.
much.
Yes, that's what I think was the point she was trying to make on that. Yeah.
Yeah.
It would still be. Now, there is an important thing that I think people need to know. So even though we have this 45-day window, it's not advised to go out. Like I would never advise someone go out and shop for every mortgage company you can or every auto loan you can. And the reason for that is, let's say the person wants to go get a credit card. Okay, so they went to an auto lender and this auto lender and this auto lender. They got 60 credit pulls because we're going to see all of them, even though they're only affecting the score as 1. We're still going to see all 60 of them, right? And then I go to, let's say, Lowe's and try to get a credit card. I'm probably going to get denied for that credit card, even if I have a 700 score, because Lowe's doesn't understand that rule. They just see all the inquiries and they say, holy cow, this person went crazy. I don't want any part of this.
Right.
So there's this caveat there. It's not affecting the score, but it could affect fundability, lendability, because you have is now
Multiple inquiries.
Right. Because they're like, what is this person doing? And the reason for that, and this is a very much in the business funding world, but it does still have effect in the personal. and people do this all the time. They need $100,000 business loan, $200,000 business loan, $1 million business loan. They go get these inquiries back to back to back of all these different companies, get all these little small loans and don't tell the other one about it. So the other one, someone might be giving them a $50,000 loan here. I'm approving you for 50,000. And then at the end, the person has $1 million of lending. And that is the reason the inquiries are really there, which I was talking about, that red flag thing. That's one of the biggest reasons that they are reporting, is to say, whoa, wait a minute, do we want a part of this? This person's obviously shopping a lot. Are they getting that and they're not telling us? I mean, and you guys know it, if you're in the mortgage industry, you get that long list and the client has to write a LOX of what all these inquiries are for, right? It's, the same reasoning, right? So I just want to put that in there. I don't advise people about shopping a lot, but shopping's okay, but I don't think it's, want to go to 15 different auto lenders and have my score pulled 20 times. I wouldn't advise that.
I've got an example of that. We had a client who we had to talk to his wife to tell him to stop going to auto lots. He had so many inquiries, the credit monitoring couldn't load his report. It kept crashing.
That's a whole nother problem, right? Oh, goodness. Yeah.
Not to change the subject, but what I've been running into lately is folks who have freezes on their credit, trying to get them unfrozen quickly so we can go in and do the work we need. Sometimes the credit agencies are two of them will be unfrozen, or one will be unfrozen, the other two stay frozen, or whatever. It's just been a little bit, not too much of a hassle, but just once in a while you run into that,
Yeah, Brian, I'm going to say I'm an expert in this area because I often have my clients freeze their credit because identity theft is such a prevalent thing right now. I really advise people to do it. However, in the past, it used to be if you froze your account, you got a 4-digit PIN that you had to remember. And most people would forget that PIN, and it could take me, I remember one particular client took me 6 months to unfreeze her file. Because there were so many, this was back in the day, right? I've been doing this 21 years, so you got to understand this, but it took me 6 months to unfreeze it, and she needed to go buy a house. Just because of, the idea of a freeze is to help protect you, right? So, I mean, they took it to the extreme. But now, and I think I wrote myself a note to do a video on it. Now it's so easy. You just have to have your logins for each individual credit reporting, that you froze it on. And you go on this button and you can click on it and you can say unfreeze, and you can even tell how long you want it unfroze for. So you could do it for that same day and then have it refrozen automatically, which I love, but it's instantaneous. When I hit that button unfreeze, it instantaneously unfreezes. Like you can pull my credit right now. And once I hit that button, you can pull it and you have it. So there's no,
maybe the client just isn't, as savvy as you are.
That's the problem.
Not clicking the right buttons, or all three of them, whatever the case may be,
and not getting through to the right department.
Right. It really works when you go online and you're in your online account, and I think I want to say it's Experian. It hides it for whatever reason. I think it's Experian. They like to make
it is Experian that hides it. I will say too, it's even easier on the apps. Like I know TransUnion is the easiest. You open the app and it's a toggle back and forth.
Okay. So, all right. I'll keep that. Thank you. That was very good information. Thank you.
Yeah. I think what I'll do, Brian, I wrote a note and I'll get does Ivory have your email, or do I have your email?
We both do.
Yeah, you ladies have it for sure.
I think what I'll do is I'll create a video as a walkthrough, and then I'll send it to you, and then you can just have it for your clients.
That would be really good.
Yeah. I've been doing that lately. When people ask me a question, I'm like, I'm going to make a video. So that no one has to ask me again. It's there. So
I love it.
Okay.
World. What?
Oh no, I was just saying new world order.
I know, right? Video for everything.
Yeah.
Okay, so myth number 2, closing old accounts boosts the credit score. We tend to see a lot of times a client thinking they're doing the right thing. They are getting ready to buy a house. They want to get rid of all of their debt so they look like the most pristine client ever to get the mortgage. And then what happens is they close every account and either have no score at all, or they close a whole bunch of accounts and their score drops and they don't understand, why did my score drop? I got rid of all my debt. I closed all my credit cards. I should look great. And this is part of the credit score algorithm not necessarily being intuitive to the typical person, right? Because credit is focused on how do I responsibly manage debt, or am I responsible in my management of debt? There has to be credit, there has to be open accounts that exist for the data to be utilized in order to establish and create that credit score. So I think that's just pretty high level. That's the issue. Timing wise too, let's say you have a debt to income issue, you need this auto loan to be paid off. If you time that properly, you can pay it off as part of closing, for example. That can allow you to not utilize that as part of the debt to income ratio, but also not negatively impact the credit score going through the lending process. So that's always my recommendation there.
The time for everything.
Yeah, exactly. And I want to also stress, we're not saying, or I'm not saying that consumers should just keep debt unnecessarily. It's all about, like Ali was saying, the timing of it. When does it make sense? If you're getting ready for a big, getting a mortgage, right? That timing is everything. You want to get the best rate possible. So let's do things at the right time to benefit your immediate financial goals.
Right.
So.
What I often like to tell my clients is, what is your goal? And
Mhm.
let's base our actions off of your goal.
Mhm.
If your goal is to get out of debt and your goal is not in the near future to buy a car or buy a house or whatever, then we work in that fashion with the knowledge that we want to try to keep the credit scores as high as possible while doing so. But in cases like if the client wants to, I just had this, and this happens a lot. I know you hear this a lot, but I want to pay off my car. It's going to help improve my credit score. Well, it's not. So why are we paying off the car? We'll pay that after you buy the house, or unless it's needed for a DTI reason. And then we time it correctly so it doesn't affect the
Right.
score. Yeah.
Right.
And
It's usually a DTI issue with us. Usually
Yeah.
DTI.
Yeah. And I
Exactly.
think what I'll pull into it too, which isn't really what the slide's talking about, but some clients also stop using their credit cards altogether coming into the lending process. Maybe not as much right now. We're seeing utilization issues in general in the US, but some clients will stop using their cards altogether. And Ali, what happens if I haven't used my credit card for the last 3 months?
It becomes inactive and now it's not helping improve the credit score.
So it has to be an active account. So it's not negative, right? It's not taking away points, but it's not giving you the benefit of that credit card because it's not considered open and active. I like to call it stale. It's just stale old data that's not usable because the algorithm is meant to predict risk. So if we don't have current data, it's not a good predictor of future behavior.
Oh, ladies, so the best thing that anybody could do is use your cards, but the best thing you could do is just pay the balance every month if you're able to do so, or a
Absolutely.
majority of it for that matter. But utilize it, use it is what you're saying. Is that
Yeah,
correct?
you do need to use it. You do need to use it. And
Right.
some people are afraid of it, but this is the game that we have to play in. So we have to play within the rules of the game. It's just the way it works.
Yeah. So to your response, Brian, is, a lot of times I'll tell my consumers, you're paying for Netflix, right? Put it on your credit card, have your credit card paid off by your bank when the balance is due. Anything that it's not that you have to go and swipe it all the time, but like you're paying for a lot of services that you could just automatically put them on your credit card and then have your bank pay that off. And that's, to me, the best way to use it. And then put the credit cards away. You don't have to have them in your wallet for temptations of sliding it, especially for people who, they have a problem and they know it and they're scared of them,
Yeah. Great.
So myth number 3, all debts are equally damaging. I would like to start this conversation by talking about some of the lesser known things about student loans. Ali, you love this topic. Can you talk a little bit about student loans and when they are damaging to the credit scores?
Yeah, so a lot of people don't realize that they have a lot of damage to their credit score. So we can have a person who has beautiful, beautiful credit, but they have a bunch of student loans and their credit scores in the 500s. That's actually a really simple, easy fix, luckily. But what happens is we go to school, our loans are deferred. We have some loans that are, some loans that are being charged interest and some that are not. And I just lost the wording for what the actual term is, but
Unsubsidized versus subsidized.
unsubsidized and subsidized, right? So unsubsidized loans would have an interest rate while you're in school. Subsidized loans would not while you're in school. So what happens is the majority of your loans will be unsubsidized and they're gaining interest all that time. So let's say you got the loan out for 5,000, it's gaining interest. You're in school for 4 years and now you get out of school and you owe 6,500, right? It's the forever loan. It's compounding interest on top of that. So it's not financially responsible to do that either. So the credit bureau says, hey, the algorithm says, hey, this person must have a financial problem because they got a loan out for 5,000, but they owe 6,500. And of course, if we're predicting, that would make sense. Now, the person didn't know any better, right? Financial literacy, they didn't know any better. They never missed a payment, but their credit score is significantly hindered because of that. And Ivory wanted me to point that out because it's a not a very well-known subject matter, that's a big issue in how credit scores are impacted with the student loans. So a quick, easy fix oftentimes would be, I would be consolidating the student loans into a brand new loan. And, or if we have the financial fortitude to pay those down to the original loan amount, maybe we do that to keep the history as well. Because, we're in school, we still have the history, but it's inactive history, right? Mm-hmm. So the best thing for a student to do, I love talking to the colleges about this, is pay the interest while you're in school. If you're getting charged $10 a month of interest, pay $10 a month. Now what you've done is your loans are not going over the original loan amount. So if they're maxed out, if my loan amount is 5,000 and I owe 5,000, that's fine. No effect to the credit score. But what I get, and if I'm making those small payments, is now I have activity for the entire 4 years.
Correct. Yeah.
Right? And I've done that with people where they'll come to me, they've been deferred for their entire school, and I'll say, make a $10 payment, a voluntary $10 payment. And they do, and their credit score jumps up, right? Because now we have this activity on this 4-year account that we didn't have, a month ago. So that's kind of little tricks that we can do. And then there's that amazing program called the SAVE program, which if someone qualifies for it, that actually stops the interest from accruing above the payment that the person has to make, which is amazing. And that's very new because a lot of people would get on, for instance, income-based repayment plans, and their payment might be zero, but their interest was still being added. So their loans were growing bigger and bigger and bigger and bigger, which could potentially be a very big problem for them if they start making money, and start having to make a payment to their student loans. But it was definitely impacting their credit score. And those people on those loans are like, well, I don't have to make a payment. So they didn't want to. And, that was a hard pill to swallow to say we need to, so we can have better credit scores, right? So the SAVE program has been an amazing thing. So if you are in the loan business or a professional and you're seeing people that are not in the SAVE program, I would recommend you have them call us because it's definitely super beneficial for them. It also affects that DTI.
Yeah.
Is that SAVE with a V or SAFE with an F?
SAVE with a V, and it's an acronym for Save on a Valuable Education.
SAVE program. Okay.
Yeah.
Thanks.
Yeah. So, really, to summarize, if the score for loans, if you owe more than that original loan amount, it's going to adversely impact your credit. And there's so many good nuggets in there. That's the one nugget I'm going to pull out for the summary. But outside of that, we're going to now answer your other question, Brian. Which card, which payment, when do I make it? How do I advise a client on an effective strategy for paying down their credit cards? So when we look at how credit cards are assessed when it comes to the credit utilization ratio is 30% of the credit score. When your cards are looked at, let's say, I'm going to give you an example. I think that's the best way to do it. Let's say I have a credit card that has a limit of $500 and another card at $5,000, and they're both maxed out. It's all a game of ratios. That maxed out 100% utilization on $500 and that 100% utilization on $5,000 are impacting my credit the same. So there's two different calculations that take place. Once on one calculation on each card individually, and then separately on the credit report overall. What is my overall credit usage versus my credit limit? So where we can focus on is starting with the smallest credit limit first. Because obviously it's easier to pay off that $500 card than it is that $5,000 card. Now, Allie likes to say pay it down to 20%. I like to say pay the whole thing off. At the end of the day, your payments on that $500 card are going to be so dang small, you're going to pay it off in a month or two after that anyway. But essentially focus on that smaller credit or the smallest credit limit first and work your way up, because that ratio is now going to be 0%, or let's say 5%, 10%, 20%, whatever. Out of that 100% prior utilization, you're going to see bigger jumps in the credit score from that. So we see a lot of proponents of, paying a little bit extra on every card every month. No, don't do that. We see some of the Dave Ramsey methods, which neither of us are a fan of. It all, in my opinion, you want to focus on how do I improve the credit scores first? Because let's say we do want to do debt consolidation loan, not debt consolidation company, not debt settlement company, but get an actual loan to pay off the rest of our debt. The only way we're going to be able to get there is if we pull the credit scores up. So if we focus first on those small cards, we're going to see bump in score, and that may bridge that gap needed to get something like a debt consolidation loan, which then if we shift all that revolving debt to a loan, we're going to see an even bigger jump in credit scores, right? Because what happens then is it's not adversely impacting utilization ratio as a loan, right? Because we're not going to owe more than the original loan amount. Make sense?
All right. Yes. And a question on that scale.
Mm-hmm.
In the utilization percentage, I
Mhm.
understand you say, hey, Ivory's all about paying it all off.
Mhm.
Allie says, hey, get it down to about 20%. My question is, if someone's at near 100% and the difference between 180, 80 down to 60, 60 down to 40, 40 down to 20, 20 down to 0 in those 20% increments, is your credit scoring going to be I guess even with that jump? So if you're paying it down from 100 to 80%, you got that 20% that you paid down, will you see some sort of a 20% increase in your score or better? Go down to 40, it's 40 down to, you know what I'm saying? Like the more you pay down, the better it's going to be. But is it equal in its increment, I guess?
It's not a one-to-one like that is really the
Yeah.
best way I can put it.
I think where you can see more of what you're talking about, a one-to-one is, and this is why my philosophy is 20% on each card, move to the next one, where Ivory says paid off. So let's say I have, in her scenario, I have a $500 card and I have a $500 balance. I have a $5,000 card. I have a $5,000 balance. The reason that I would suggest getting that down to 100 and not paying that extra 100, because if I have that extra 100, let me put that on that $5,000 card, right? Because what I'm trying to do is get line by line at 20% as well as overall, right? Because that's where I'm affecting the credit score faster. So it's all about how do I do this as fast as possible. But if I were to say, across each one, I was at maxed out and now each one is at 40%. My utilization then was also going to represent 40% overall. I think you're going to see more of that one-to-one jump than if they were, one's at 20%, one's at 100%, if that makes sense.
I got you. Yes. Thanks.
So to that effect, I'll just, like, if I were to get a personal loan, which is what I oftentimes do with my clients, we get a personal loan to pay down those credit cards. Let's say I didn't get enough to pay off the credit cards, right? But if I got enough where I can get each line item down to 20%, that's what I'm going to do. Right. So that I can cross the board. Yeah.
Yeah. And that's a strategy that we'll use too for people who want a HELOC to pay off debt. Personal loans are a great bridge. They're a great in-between product if that client does have equity, because we know their rates are still high, but we're gonna see a credit score jump, and it's still a heck of a lot better than what we're seeing on credit cards right now. And even if they don't get that HELOC, they're still paying their debt down faster. We've got an amortized
Right.
product that they're using.
Yeah.
Yep.
And I think that's important to even mention, like, you know, you start out, I call it the stepping stones, right? Or playing the money game, right? So we get the credit score up enough to where we get the personal loan. Now we can get all the cards down to at least 20% or pay them off if possible. Now we have the credit scores jumped up. Now what's our next move? We're, you know, maybe we're getting a HELOC to pay that off. So now we have a tax deductible interest rate, you know, the interest that we get to use. So, you know, it's a stepping process, but we can, you know, from one step to the next, we're financially improving the situation because what credit cards are 29 and 34.99% right now. It's crazy. Now, personal loans are probably a 17%, but that's a lot better than
Pretty
20.
good. They're 17 to 20 right now is what I'm seeing.
Yeah, right. And so, you know, that's still a lot better than what we were
Yeah.
doing in the credit card range. And now we pick up the score. Now we get into a HELOC. I mean, you're just constantly from one step to the next improving the situation.
And then you can do the
So
auto
with-
next, right?
With that comment, Allie, and you say, hey, we got the score up to where we can do a personal loan. What is that score? Is that mid 60s, sixes, high sixes,
Yeah,
low
usually-
sevens?
Usually I can get them approved for a personal loan. Now there's a couple of different variable things
Yeah.
other than the credit score that, you know, personal lenders are looking at. Obviously their income, can they afford it? But typically if
Right.
I can get you to a 600 score, I can realistically make that happen. Mhm.
There
That's
are
good.
gonna be
Okay, good.
some origination fees with those too. If the
Yeah.
scores are lower, we're seeing, just to clarify. It's
Sometimes. Mhm.
Yeah, it's something that, you know, just to be prepared for, but overall, it's just a way better financial picture for the client. And they feel better too, because they see their debt going down. At first, they may be a little like, ugh, sucks, but then they see it going down where they don't see it with the credit cards. Right now, they see it keep going up. So,
Great, thank you.
yeah, that's always a fun one. Okay. Paying off okay, this is a fun one. Paying off negative records or negative items immediately improves my credit score. So, Allie, what happens? I want to talk about this one first just because I think it's fun. What happens if I pay a collection that hasn't been reporting to the Bureau for a really long time?
Okay. And if we're specifically talking about mortgage credit reports and FICO 8, okay, FICO 9 works differently.
Yeah, I'm not talking FICO 9.
Okay.
Yeah.
No one really uses FICO 9 anyway, but
No.
FICO has a whole different way of doing things, which paying off a negative debt would be very great for you to do, but it never took off the ground. So we're going to focus on what we do have. So we're FICO 542, obviously a mortgage one, and then we have FICO 8. So those FICOs say that if, and this is where you have to be a little bit of an investigator on the credit report. You got to look at these dates on the credit report. If the date of last activity, the date of last reporting date, excuse me, I said that wrong. Those are two different things. Date of last reporting date was 2 years ago, and I pay this negative item off, I'm actually going to decrease the credit score. If the reporting date has been in the most recent 2 years and I pay it off, I can improve the credit score by paying it off. And I have a fun story where I had a loan officer who's a friend of mine who, you know, referred his clients to me all the time, but he took a class of mine and he thought, oh, I know things now, which is fine. But he told his client, he had a client, he said, hey, you got these medical collections, just pay them off. This is before the new rule, guys. This is back before the new rule. So let me clarify that. He tells them, pay these collections off and then come back to me, let me know, and I'll pull your score and I will get you a loan. Keyword I will was another keyword that he said. Well, he didn't realize that that date of reporting was on there and it was way past 2 years old. And he had him pay it, and that person's credit dropped 60 something points. Keep in mind, this person only needed 6 points to get approved for the mortgage. Dropped him 60 something points. Of course, my loan officer friend calls me. He's like, this guy's cussing me out. He's saying he's going to sue me. you got to help me. So, what I end up having to do is get those off of his credit report entirely. But the fact is, I might not have been able to do that, right? He got lucky and I was able to do that. But by paying those off, it had actually dropped his score. So it's important that those dates are read before we advise on whether or not you pay something or not. Now, of course, medical collections.
Don't go to medical yet. That's
okay.
next.
Okay. They have a new rule and it's different now, but I'm just using that as an example.
Yeah. Which is our next slide. So we'll talk about that in a second. But basically just understanding as well on top of everything Allie explained too is paying a collection doesn't guarantee it's going to get removed from a credit report either. So that's a common misconception. Another common misconception just from consumers in general is they think a paid account in general no longer is going to adversely impact their score, or when they close an account, it's not going to adversely impact their score if there was late information, right? None of that is true. But I'll leave it at that because I'm getting short on time. Medical collections. Now we're here. So you should ignore medical collections because especially if you're a loan officer, you don't need to look at them anyway, right? They don't matter. The underwriters don't care about it. But Allie, I'm going to let you talk about it because you were already going that direction anyway. So you might as well continue on with this section. Why should a loan officer, especially in the mortgage space, care about medical collections?
Yeah, and I would say more today they should care about them than any other time because of the new rule. And I'm emphasizing the word rule here. It is not a law, so it can change at any point in time if the credit bureaus decide to do so. But it is a rule that the credit bureaus have that if a medical collection is paid off, it is completely removed from the credit report as if it never happened. So that paid off means it could be settled and paid. It doesn't matter how it got paid. It would be completely removed. So in this instance, we don't care about the last reporting date at all, right? A complete removal of a medical collection has the same weight as let's say if we were to get a utility bill collection removed, they have the same weight. And a lot of mortgage lenders don't understand that. They think that medical collections don't have weight on the credit report. It certainly does. And it is a heavy weight, especially if it has reported in the most recent 2 years. So if you want to impact someone's credit score fast, it would be paying medical collections. Okay. So the underwriter doesn't care about medical collections. So we have to look at the overall picture when we make a suggestion, right? Do we have to pay certain things for the underwriter to approve this loan? Obviously that's first and foremost. But if we're trying to get this score up so that we can get approval, medical collections are your candy. And those would be the ones that you would want to target.
Yeah.
That's great advice. Thank you.
Yeah.
And this one I'll be kind of quick on because as per our usual, we're going long. So credit scores. A lot of clients are just really confused about credit scores. They're checking Credit Karma. You're pulling their mortgage lending score. I'm going to highlight that here. Laser pointer. So you're pulling the mortgage credit scores. They're applying for an auto loan and they're getting auto lending scores. Then they're applying for a credit card and they're using credit card scores. And then we see more and more algorithms. They also have the Vantage credit score versus the FICO credit scores, like we saw in the prior slide, was all FICO scores, right? So the whole point of this, I'm not going to go into the details too much, but all of these credit scores are accurate. All of these credit scores are valid. There's nuances in how they interpret the information. And they're all right. So it creates a lot of confusion for the consumer, for the client. And instead of it being a battle of which score is right versus which score is wrong, they're all right, but they're interpreting information differently. They're all looking at similar things. If you're doing the right behaviors, all scores are going to be higher than what they would be if you are, not paying things on time. I'm just gonna be really overly generic. I'm going to leave it that high level, but Allie, is there anything you really think is pertinent that we should add in this category?
No, maybe what you said, there's multiple credit scores. They're all right. It's just what are you trying to do? And that's the right score you can be effectively trying to improve, right?
Can you jump back a screen, please?
Absolutely.
Thank you. So at the very bottom, the newly released version, now it's all 9, and you had mentioned 9 earlier. It was either
This isn't
Allie
even
or I, but
updated.
you.
Yeah.
So this 9 replacing everything else, 8, 5,
Nope.
4, 2, 3, and it's just 9 now, or
No.
specifically mortgages
That's-
still using mortgage, credit cards using credit
Yeah.
card, autos using auto.
Yep.
Yeah, this new
Um,
release of 9 came out and the credit bureaus were really pushing everyone to use it and no one did. There's very
Yeah.
few lenders that would use FICO 9. So since then, the credit bureaus have come out with FICO 10T. That's the one that we will all be adapting in 2025.
Yeah.
In 25, okay.
So we're actually just, we can kind of like say we skipped over 9, no one liked it. We're going to FICO 10T in 2025.
And we will be having a separate webinar just on 10T.
I was going to say that would be great. I was about to
Yeah.
ask you if you would do that. Awesome.
Yeah. Yeah.
We're learning. There's we're trying to get as much data on how that is going to work because it's going to affect lenders significantly. We're all going to be confused. Consumers are going to be confused. So Ivory and I are taking a big initiative to find out so that we can share that with as many people as possible before the effect actually happens.
Exactly. Exactly.
All
All right, so let's talk about AI because part of the question is, okay, so this is super confusing for consumers, confusing for even people in lending. So how can we use AI to help you close more loans, help you do more business and deal with the confusion from things like the score models and everything else we talked about thus far with the myths? I'll stop switching screens. Okay. So Credit Score Pro AI, we created it for several reasons, but we'll look at what that AI does here in a moment. But the point of Credit Score Pro AI is to give access to the opportunity to get and then maintain strong credit for everybody. We want to give the ability to dispel all of these myths that we see and the ability to easily access, manage credit in one single platform rather than a consumer having to go all over the place.
Or getting the wrong information and sources like social media and things like that.
Yeah.
Right.
Yeah. And so in utilizing the platform, obviously it can help you build trust with your clients. It can also, you can use it to yourself. But with the education component that's in there, that can also help you have strong conversations with clients and be a good advisor for them. All right, here we go. This is what this slide's about. The whole point is you want credibility, right? You want to be above everybody else in the industry. And if you have all of the answers and solutions, even if you yourself are not the solution, that's going to keep your clients with you, right? They're not going to go searching for answers elsewhere, looking for greener grass on the other side, right?
Yeah, and I would like to add to that, the
Please.
millennials in general are very hungry for knowledge. And so these are new people who are buying homes and all this stuff, right? They're very hungry for knowledge. They are searching for what they call trusted advisors. So I think in any profession where we're at now, we need to be the answer on a lot of things. Like a real estate agent needs to know about every single contractor out there and different, you know what I mean? You need to be a trusted advisor in a lot of areas, but especially for our mortgage lenders in general, and specifically, I should say, is that Credit Score Pro creates a platform for an educational platform, really deep diving into credit and how it works, so that you can be the expert and the trusted advisor to help them understand credit, especially, and Ivor, you're going to have a fun time with your educational platform when FICO 10T comes out, right? Especially coming into new
section.
Yeah, when we're going into FICO 10T, which is going to be massively confusing for everyone, I imagine.
Yeah.
But it provides that educational platform. So a lot of lenders use Credit Score Pro, not necessarily because they have a credit issue or want to improve credit for anything, but because of that educational platform that's also in there. And of course, that's there for the consumer as well.
Absolutely. And so the way the AI functions and its capacities to help you with the client base is when we get a credit report, Credit Score Pro is connected with Smart Credit, which is an amazing credit monitoring provider. And that credit report is automatically connected with Credit Score Pro. Credit Score Pro's AI is automatically scanning the raw data file of that credit report. And this is what it looks like on that back end. So on the right-hand side of the screen here, this is that raw data code. So when you look at a credit report, whether it's like this from a monitoring company or whether it's from the vendor that you're getting your credit reports from on the lender side of things, they're only showing you pieces of that data. They're only showing you parts of it that they want you to see. There's so much more behind the scenes. So the importance of having that AI be able to sift through all of this information is that it can identify the proper types of disputes, the compliance issues, any problems with that credit report that allows that consumer to say, hey, these are the negative accounts, but Credit Score Pro, tell me what's wrong with those negative accounts that can allow me to generate a dispute, right? So all the client does is choose the accounts they want to dispute. Of course, we're going to recommend choosing every negative account. We want the AI to be searching every possible issue with those accounts, and then it creates the dispute. The dispute it creates is going to be based on success rates as well, and even lack of success rates. So it is fully machine learning. So based on the successes or lack of successes from prior disputes from every single user of Credit Score Pro, it's going to continue to refine and get better and better as well. The only time we ever suggest deviating from this suggested reason code is going to be not reason code, sorry, but the suggested dispute reason is going to be in the event of fraud. And the AI doesn't know if there's fraud, right? So it has to be up to the user to say, hey, this account was fraudulent. And so that's going to be the only time they change the drop down.
Yeah.
Anything you want to add?
No, that's perfect.
Okay. And then outside of that, the preferred methodology for sending the dispute. So clients automatically going to be walked through doing this for each credit bureau, for each account on each credit bureau. Once they finish generating those disputes, it's going to automatically create the dispute letter for Equifax, Experian, and TransUnion. That dispute letter is going to be emailed to the client. They can also, of course, see it in their portal here in Credit Score Pro. They can print it, and then we suggest them handwriting their signature, their date of birth, social security number, all that. And then we'd like them to print it and mail it to the bureaus. We do this for a variety of reasons. Reason number one, the bureaus are more likely to look at something with handwriting on it. Reason number two, the bureaus are more likely to look at something that is postmarked from the client's area, like where they live. I'm having trouble with the word, but you get my point. And we don't want them to deal with unnecessary stall tactics. Bureaus don't like investigating. They're going to do what they can to limit investigations. We can do what we can on our end to increase the chances that we don't have those stall tactics used. And so that's our suggestion. However, we do know some people don't have printers or just won't go through the effort of printing themselves. So we do have an integration with maildash.io who they'll send the letters for the consumer. And then lastly, I will say automatically at 40 days, it's going to import the new credit report and that process will start over again. How has the credit report changed? There's a comparison from the prior report to the new report, creates new disputes, updates obviously based on what's already been removed from the report and all of that. And then outside of just the dispute side, right? That's only a part of what can help someone with their credit score. We also want to look at everything else. We talked about a lot of that today. So AI helps to bridge the gap between optimizing those good accounts. How do we get more points out of those good accounts that we do have on the credit report? And how do we fill in the gap where that client is not affecting the credit score algorithm and they could be, or at least not effectively? And we also looked at all those different types of credit scores, all those different models of credit scores. So depending on a client's goal, we know those different models are being used. If they want to get a car, it's a different model. If they want to get a house, it's a different model. So building that goal-based factoring into the AI was super imperative. And this was Allie's baby. So you got to interrupt me if I'm not doing it justice.
You're fine.
But essentially that client's going to choose their goal, and they can change their goal at any point in time. They might start with the goal of getting out of debt and then move to the goal of buying a home. And based on that goal, the AI is going to determine the best, most effective and efficient methods to improving their credit scores outside of just that dispute side of things. And so it's going to prioritize it by the most effective, most efficient first. And then as they complete each of those tasks, it's going to mark one off. Hey, this is completed. Awesome job. You completed this. They have the satisfaction from seeing that they've completed it and getting that recognition. And then it's going to move on and fill up with the most effective next steps. This can be updated at any point in time, but will automatically be updated each time there is a new credit report. And if they don't ever choose a goal, we automatically send them an action plan based on just general credit improvement. But wait, there's more. So the AI is also going to look at the credit building tools that make the most sense for that client as well. So does it make sense for them to add rent on their credit report based on their goal? We know that at least right now, adding rent isn't going to impact the algorithm used in mortgage lending, but perhaps their goal is to get a car, right? And it's going to affect that. So all those factors are considered. And then we, of course, wanted to make sure we incorporated financial literacy, that educational component. And this is something whether users have, not every user has credit damage. They're not necessarily all using that dispute side. And those that are there to manage their credit are focusing primarily on this action plan and then also on the credit education section. And so this section breaks down into a whole bunch of different modules that we will add to with FICO 10T. So there'll be a whole new reorganization of everything once we know even more about 10T, but goes over why credit matters, all of the good stuff about credit. We do have a section on myths. We teach how to read the credit report, how to establish and reestablish credit, and everything in between. And with that, that's pretty much everything. And there is the ability to access Credit Score Pro at creditscorepro.ai, of course. We do also have the credit building tools all readily available on our website. We, of course, recommend using the action plan to determine what makes the most sense. And then we do these webinars every single Thursday, different topics. We would also encourage you to join our Facebook group. We need more professionals there as well for clients who are consumers in general who have credit questions. And then I don't know if I'm missing anything, Allie. I'm talking fast at this point just because we're at 3:12.
Yeah, no, you're great.
So
Great job.
Ladies, thank you so much. I have to jump, but I got to tell you, it was very informative, and I truly appreciate your help.
yeah, absolutely. Good to see you again, Brian.
Yeah,
Okay.
very good. Take care.
See you.
Bye.
Okay, Allie, I'm gonna stop the live.
Okay.
Give me 1 second. Okay.